Are you seriously worried because silver started dropping after hitting $83? You saw the red candles, you felt your stomach drop, you started thinking, maybe I should sell before it gets worse, right? Stop, right there. What you need is not to panic. What you need is to understand what's actually happening and how markets really work. My name is William Lee, but you can call me Bill. And today I'm going to teach you exactly why they're installing fear in your mind to make you sell. Because that's what this is. This isn't a market correction. This is a psychological operation designed to separate you from your silver before the real move begins. It's January 8th, 2026, and the financial media is having a field day. Silver crashes after Bank of America report. Bubble bursts as silver falls from $83 to $78. Investors flee precious metals. The headlines are everywhere. The panic is palpable. The fear is being pumped into the market like poison gas, and retail traders are doing exactly what they're programmed to do. They're selling. But let me show you something that the talking heads on CNBC won't show you. Look at this chart. Do you see all that liquidity sitting below $77 down to $70? Do you see those levels? Some people call this an ascending trend line. Technical analysts call it support. But you know what the institutions call it? They call it a liquidity channel. They call it a retail trap. They call it a hunting ground. Let me be very clear about what's about to happen because I want you to be prepared mentally. Silver might correct down to near $70. It might. I'm not going to lie to you and tell you it can't happen. But here's what you need to understand, my friend. Silver, like gold, is more bullish right now than it has ever been in modern history. Ever. This pullback, this correction, this crash from $83 to $78, it's nothing but a liquidity grab before the explosion that takes us to triple digits. Do not fall into the trap that the institutions are setting. The only thing they're desperately hoping for is that you hit that sell button. They want you to panic. They want you to give them your silver at a discount. They want you to get stopped out so they can accumulate your position and liquidate your account. This is how the game works. I've known many traders who play with billions and billions of dollars, and they are anxious. They are eager to make you touch your stop loss and take your money. So if you want to ride this wave, you have to learn to surf. You have to understand the ocean. You have to know when the big wave is coming and when it's just chop. And please, please don't do day trading if you're not naturally talented at it. The statistics are brutal. 90% of day traders are not profitable. 90%. That means if you're day trading silver right now, trying to catch every $2 move, you're probably losing money and you don't even realize it yet. If you want something safer, something smarter, something that actually works, you enter swing positions, wide stops, below $60 or $50, and you let everything rise calmly. You don't check the price every 5 minutes. You don't panic when you see red. You understand that volatility is the price you pay for exponential returns. As I've said in my previous videos, silver will break $84 very soon. They're just playing with the emotions of the masses right now. They're installing the sentiment of panic, of fear, of doubt. The only fear you should have right now is that the paper dollar in your wallet will only be good for wiping your ass. That's the real fear. Not that silver dropped from $83 to $78, but that the entire fiat currency system is collapsing and you're not positioned in hard assets. And let me tell you something else intelligent you can do right now. Buy silver coins. Or gold coins. But silver coins are more advantageous for small transactions. Think about it. If tomorrow the great reset arrives, if the dollar becomes worthless, how are you going to negotiate with people? How are you going to buy food? How are you going to exchange value? A gold coin might be too much value for a loaf of bread, but a silver coin? Perfect. That's the right denomination for everyday transactions. This is why you need to get yourself a good jar full of little silver coins. That will always have value. Diversify your investment. Don't put all your money in the same asset. You're investing in silver? Do it in physical and in paper. Both. Be intelligent, have options, have flexibility. Because when the system breaks, the person with only paper positions gets wiped out. The person with only physical can't trade quickly. But the person with both, they survive and thrive. Now let's continue with our analysis because I need you to understand the machinery of manipulation at the deepest level. Throughout my career, I have witnessed many campaigns designed to manipulate the minds of the masses. Let me give you a specific example of how this works behind closed doors, because most people have no idea. The big banks want to manipulate the masses? Very simple. They make contracts with television networks or with the largest news agencies in the country, and they say, if you spread fear to make silver fall, I'll give you X millions of dollars. The news network says, oh, of course, that interests me very much. So what do? They tell you it's the end of silver. They tell you it's going to fall. They tell you we're in overbought territory. They tell you silver is overvalued. They bring on experts who explain very convincingly why you should sell immediately. And people start to sell. People sell and sell and sell. And when the price is corrected enough to be a good opportunity for the big banks, then they inject the liquidity that will bankrupt you and shoot the silver price to the moon. The price goes sky high without you because they expelled you from the game. They manipulated the narrative and you took the bait. You bit the hook, and now you're watching from the sidelines as silver does exactly what you thought it would do, just without you in the position. This is an emotional game. It's a game of cold minds and iron discipline. You know this now. If your emotions suffer too much, maybe you need to invest less, or invest only what you can afford to lose. But under no circumstances should you have your emotions doing the yo-yo. You need to know what you're doing. You need to understand how this game works. It's like chess. Every move has a counter move. Every trap has an escape, but you have to see the board. Let me walk you through exactly what happened yesterday, January 7th, because this is a masterclass in market manipulation. Bank of America, one of the largest financial institutions on the planet, issued a research note. The headline, silver could hit $309 per ounce. $309. The number was everywhere. Twitter exploded. Reddit went crazy. YouTube was flooded with videos. Every retail investor saw that number and thought, I have to get in now before it moons. So what happened? This morning they rushed in. They pushed the price of silver all the way up to 82.75s. It looked like a breakout. It looked like the start of the run to triple digits. The euphoria was palpable. The FOMO was overwhelming. And then, at the exact moment when euphoria hit its peak, when everyone was convinced we were going to $100 by Friday, the trap snapped shut. A massive wave of selling hit the market. The price didn't just stop, it collapsed. We went from 82.75 to 78.54, down 262 on the day, more than 3% drop. If you bought the high at 82s, you're already down 5% in a single afternoon. Your account is bleeding red, your emotions are in chaos, and you're thinking about selling to stop the pain. This, my friends, is a textbook financial maneuver known as selling the news. The smart money used the bullish headline from Bank of America to dump their positions onto the dumb money who chased the hype. Think about it. If you're a hedge fund manager and you bought millions of ounces at $60 and now the price is $82, you have massive profits. But you have a problem. If you just hit the sell button, your order is so big that it will crash the market before you can get out. You need buyers. You need millions of retail investors to step up and take your bags. How do you find those buyers? You need a headline. You need a story so exciting that people rush in without thinking. Enter the Bank of America report, silver to $309. Whether by coincidence or by design, this report provided the perfect liquidity event. When retail investors read that headline, they flooded the market with buy orders. They created a wall of liquidity at $80, and the hedge fund said, thank you very much. They sold into that strength. They sold into the greed. They used the retail buying pressure to absorb their selling pressure. This is why the price crashed the moment the news went viral. The smart money was distributing their shares to the late money. It's a tale as old as markets themselves. Buy the rumor, sell the news. The rumor was the breakout. The news was the $309 target. And the result was the crash that shook out everyone who bought at the top. Now let me show you the technical picture because the chart is telling a very specific story. Look at what happened on December 29th during Ghost Week. Silver spiked to 83.71 and crashed. That was the first rejection. Now January 7th, we rallied to 82.75 and were rejected again. We failed to break the old high. In technical analysis, this pattern is called a double top. It looks like the letter M. It's traditionally a bearish reversal pattern. What this tells us is that there are aggressive sellers defending the $83 level. Every time we approach it, they step in and smash the price down. This creates a ceiling. But here's what the textbook analysts don't understand about bull markets driven by fundamental shortages. Double tops often turn into cup and handle patterns. Instead of crashing to $70 like the bears expect, the price goes sideways. It consolidates. It digests the supply. And then, when the sellers run out of ammunition, it rips through that double top like it was never even there. I believe we're forming a handle, not a top. Why? Look at the volume. Yes, the selling volume was high yesterday, but was it panic level high? Was it capitulation? No, it was profit taking. And more importantly, look at what's happening at $78. Every time the price dips to $78, it bounces. We're not crashing through the floor, we're sitting on it. This tells us that there are massive buyers sitting at 78, absorbing all the selling pressure. These are the institutions, these are the pension funds. They didn't chase the price at 82s. They're not stupid. They waited. They let the emotional traders flush the price down to them. And now, they're quietly accumulating millions of ounces at a discount. When you see high volume but the price refuses to go lower, it means accumulation is happening. The metal is changing hands from weak hands to strong hands, and strong hands don't sell. They hold for the next leg up. So, Where are the critical levels you need to watch? Let me give you the exact numbers. The Fortress is built between $75 and $78. At $78, this is immediate support. This was the breakout level from earlier in the week. If we hold here, the bull market is incredibly strong. It means we didn't even need to retest lower levels. At $75, this is major support. This was the ceiling for all of December. Remember the golden rule of technical analysis. Old resistance becomes new support. If the price falls to $75, it should bounce hard. The entire market is watching that number. Banks, algorithms, retail stackers, everyone has buy orders sitting at $75. Now, if we break below $75, then we have a problem. That would invalidate the breakout. That would be a failed move. That would suggest we're going back to the 60s to reset the entire rally. But right now, we're more than $3 above that danger zone. We have a massive buffer, so don't let a 3% drop scare you when you have a 20% cushion below before the trend is threatened. Let's talk about gold for a moment, because gold is the leader, the parent, the steady hand that guides this entire precious metals complex. Gold is trading at $4,453. It's down $32 yesterday. That's less than 1%. While silver dropped 3%, gold barely moved. This tells us that the selling was exaggerated in silver. Silver overreacted to the downside just like it overreacted to the upside in the morning. Silver is an emotional teenager. Gold is the steady parent. And right now the parent is fine. The parent is still holding above $4,400. The parent is still in a powerful uptrend. And silver cannot enter a bear market if gold is in a bull market. The physics of the market won't allow it. The gold to silver ratio widened slightly yesterday from 56 to 57. You know what that means? Silver just became cheaper relative to gold. This attracts value buyers. The algorithms that trade the ratio will step in to buy silver and sell gold to close the spread. This is automatic. This is mechanical. This creates a natural buying pressure under silver whenever it underperforms gold. Now I need to address the elephant in the room, the Bank of America report that triggered this entire mess. Silver to $309. Let me tell you something about this report that most people are missing. The fact that Bank of America, a bank that has been historically short precious metals, is now publishing bullish targets is a massive signal. It means the narrative is changing at the institutional level. For years, Bank of America told their clients that silver was a waste of time. They said it was just an industrial byproduct. They held one of the largest derivative short positions in history. They were the Death Star keeping the price suppressed. But yesterday, the Death Star fired its laser in the opposite direction. They didn't just upgrade silver, they repriced the entire asset class. They admitted three things they've denied for decades. First, they admitted that supply is inelastic. Miners cannot simply turn on the tap. Even if prices rise, mine supply will remain flat or falling for years. This kills the bear argument that higher prices will fix the shortage. Second, they admitted that solar demand is unstoppable. For years, they said engineers would replace silver with copper. Now they're admitting that's false. The green transition will consume silver faster than we can dig it up. Third, they admitted the monetary premium. They linked the price of silver not just to industry but to gold. They admitted that silver is money. This is total capitulation. It's the financial equivalent of a general surrendering his sword. The bank that fought hardest against silver has admitted that the math is undeniable. Now, why does this matter if the price crashed yesterday? Because pension funds don't trade off YouTube videos. They trade off research notes from major banks. Imagine you're a conservative fund manager handling retirement savings for firefighters and teachers. You want to buy silver, but you're scared. You don't want to get fired if it crashes. You need cover. You need a piece of paper from a respectable bank that says it's okay. Bank of America just handed them that paper. This report is a green light. It tells the institutional world that the water is safe, the fundamentals are real, you're not crazy for buying this. This removes the reputational risk of owning commodities. So while day traders were selling the news yesterday, the real money, the allocators, the pension funds, the sovereign wealth managers, they were reading the report. They were forwarding it to investment committees. They were preparing buy orders for next week. But let me ask the cynical question. Why would Bank of America publish this now? If they're short silver, wouldn't they want to talk the price down? Yes, unless they're not short anymore. The only logical reason for a bank to publish a $309 target is if they're net long. We believe that during the Ghost Week volatility in late December, Bank of America covered their massive short position. They used the liquidity chaos to exit the trap. And now that they're out, they want the price to go up. They've switched teams. They went from suppressor to promoter. This explains the violence of the rally in early January. It wasn't just retail buying. It was the banks front-running their own research reports. This is how Wall Street works. First, they crash it so they can buy. Then they tell you it's going to the moon so they can sell it to you later. We're in the tell you it's going to the moon phase. And while that's cynical, it's incredibly bullish for the price because you want the banks on your side. And now they are. When a major bank puts a number like $309 into the public consciousness, it changes the Overton window. Before yesterday, if you said $300 silver, people called you insane. Now they say, well, Bank of America thinks it's possible. It normalizes the idea of hyper-bullish prices. It moves the goalposts. Suddenly, $80 doesn't look expensive. It looks cheap compared to $309. This psychological shift is critical for sustaining a bubble. You need the public to believe that upside is infinite. This report creates a self-fulfilling prophecy. Traders buy because they think others will buy. Refiners hoard because they think they can sell higher later. Miners hold back supply because they want that Bank of America price. The target creates the behavior that makes the target come true. So don't underestimate the power of this headline. The price dropped yesterday because of mechanics, but the value of the narrative just went up tenfold. The idea of $300 silver has been planted in the collective consciousness of the market, and ideas are bulletproof. Now let me tell you what's really happening with that liquidity I showed you earlier. Look at the chart again. See all those stop losses clustered between $77 and $70? That's not an accident. That's deliberate positioning by retail traders who think they're being smart. They think, I'll put my stop at $75 to protect my capital. But the market makers can see those stops. They know exactly where billions of dollars in stop losses are sitting, and they're going to hunt them. This is what I call the liquidity channel trap. The institutions see that ascending trend line from $60 to $80, and they think, perfect, we can shake this tree one more time. They engineer a drop from $78 to $72, triggering every stop loss along the way. Retail panics and sells. The institutions accumulate every ounce at a discount. And then, after maximum pain has been inflicted, after every weak hand has been shaken out, the price reverses violently. It gaps up from $72 to $80 overnight. Everyone who sold at $75 watches in horror as the market does exactly what they thought it would do, just without them. This is why I tell you to use wide stops. Not at $75, not even at $70. Below $60 or $50 if you're using stops at all, because the market makers will hunt anything tighter. They have sophisticated software that can see the order book. They know where you're vulnerable, and they will exploit that vulnerability ruthlessly. The game is designed to take your money. Your only defense is to position yourself so far away from the battle that you can't be touched by the shrapnel. But here's what the institutions can't manipulate: the fundamentals. Did solar panels stop needing silver yesterday? No. Did the US debt stop growing? No. Did miners suddenly discover massive new deposits? No. Did China stop printing yuan to buy commodities? No. Did the Pentagon cancel their $7.4 billion smelter project? No. Did COMEX magically refill their vaults? No. Nothing fundamental changed. The only thing that changed was sentiment. And sentiment is temporary. Math is forever. The math that supports $309 silver is still valid. Inflation plus scarcity plus monetary reset equals triple digits. That equation hasn't changed. Yesterday's price drop was a sentiment event driven by emotions, not fundamentals. And in markets, fundamentals always win eventually. It might take days or weeks or months, but the math inevitably prevails over emotion. If you bought silver because you believed in the $300 thesis, because you understand the supply deficit, because you see the Great Reset coming, then a $4 drop should not scare you. It's less than 5% volatility on the road to a 300% gain. Keep your eyes on the horizon, not on the pothole you just drove over. The pothole doesn't change your destination. It just rattles your suspension a bit. Let me tell you the hardest advice in finance. Sometimes the best trade is no trade. When the market is whipping back and forth like this, when it's trapping longs and squeezing shorts, the best thing you can do is step away. Turn off the charts. Stop checking the price every 5 minutes. Go outside. Live your life. Because if you try to trade around this volatility, if you try to sell at $78, hoping to buy back at $75, you will get whipsawed. The market will reverse the second you hit sell. It's programmed to maximize your regret. The algorithms are designed to hunt emotional traders. The strategy for the rest of this week is passive observation. Let the banks fight it out. Let the algorithms churn the volume. You own physical metal. You're outside the casino. You don't have to place a bet on every spin of the wheel. You already own the casino. Just wait for them to finish playing. Your silver isn't going anywhere. It's sitting in your safe. It can't be margin called. It can't be stopped out. It can't be hacked or frozen or confiscated with a keystroke. That peace of mind is worth more than trying to catch every $2 swing. However, if you're sitting on cash, if you missed the breakout at $70, yesterday's crash is your second chance. It's the market giving you a mulligan. We're back in the buy zone. Any price between $75 and $80 is a gift. You're buying a breakout asset that's retesting support. This is the lowest risk entry point you'll get for months. Stop waiting for $60. That ship has sailed. $60 is gone forever. The new floor is higher. Recognize the opportunity in the crisis. While everyone else is panic selling, you should be calmly accumulating at the discount. Now let me address what you should be doing with your physical silver strategy, because this is where most people get it wrong. You need to diversify, not just across asset classes, but across forms of silver. Don't put everything into 1,000 ounce bars. Don't put everything into American Eagles. Have a mix. Here's why. Large bars are for wealth preservation. They're compact, they're efficient. The premium overspot is minimal, but they're not divisible. You can't break off a chunk to buy groceries. This is where coins come in. Silver coins, especially recognizable ones like Eagles, Maples, or Philharmonics, are perfect for transactions. If the Great Reset happens tomorrow, if the dollar becomes toilet paper, how will you trade with your neighbors? A 1-ounce coin is the perfect denomination. It's enough to buy substantial goods, but not so much that you can't make change. Think about the practicality. You can't buy a loaf of bread with a gold coin worth $4,500. That's absurd. But a silver coin worth $80? Perfect. That's a reasonable transaction size. This is why throughout history, silver has been the currency of the common people, while gold was the currency of kings. Silver is money for everyday commerce. Gold is money for settling international debts. You need both, but silver is more practically useful in a collapse scenario. So get yourself a jar, a safe, a hiding place, whatever, and fill it with silver coins. Make sure they're recognizable. Government-minted coins are best because people trust them. When the system breaks, when banks close, when ATMs don't work, those coins will be the most valuable thing you own. Not because of their metal content, but because of their utility as a medium of exchange. This is real preparation. This is intelligent diversification. Also diversify between physical and paper. I know I've spent this entire video telling you that paper markets are manipulated. They are. But that doesn't mean you shouldn't use them strategically. Physical silver is your long-term hold, your insurance policy, your generational wealth. Paper silver, mining stocks, ETFs, futures if you know what you're doing. Those are your trading vehicles. You can move in and out of paper positions to accumulate more capital, which you then convert to physical. The people who build real wealth in bull markets do both. They trade the volatility to stack more ounces. They're not married to any single position. They're fluid, they're adaptable. But their core holding, their foundation, is always physical metal that cannot be taken from them. This is the strategy of intelligence. This is how you win the game while everyone else is getting played. Let me give you the final verdict on what to watch over the next 48 hours, because this is critical. In professional trading, amateurs open the market and professionals close it. The daily noise, the spike to $83, the crash to $78, that's just intraday warfare. The real trend is determined by the weekly close. We have 2 days left this week, Thursday and Friday. The battleground is simple. The bulls need to close the week above $75. If we close above $75, the weekly candle will show a long wick but a green body. It confirms we're holding the breakout level. It tells the algorithms that the trend is up but volatile, which is acceptable in a bull market. But if the bears manage to push the price below $75 by Friday afternoon, it prints a failed breakout on the weekly chart. That would signal a deeper correction is coming, possibly back to the 60s. Given the physical shortage, the gold strength at 4,450 plus, the Pentagon's desperation, China's $48 trillion buying spree, the odds heavily favor the bulls holding the line at $75. But watch it closely. That's the line in the sand. That's the difference between a dip and a trend change. Everything else is noise. So here's my final message to you. You've survived the shakeout. You're still standing. The price dropped from $83 to $78 and you didn't panic sell. That means you understand something that 90% of traders don't. The destination matters more than the path. The road to $300 is not a straight line. It's a war. There will be ambushes. There will be retreats. There will be days like yesterday where you take shrapnel and your account bleeds red. But you keep marching forward. You hold the line. You remember why you started stacking in the first place. Because the dollar is dying. Because the system is rigged. Because only physical assets will survive what's coming. The Great Reset is not a conspiracy theory. It's happening right now. Gold at $4,500 is the proof. Silver will follow. The ratio will compress. The repricing is inevitable. Don't let them steal your conviction. Don't let them steal your silver. The fear campaign will continue. The media will keep pumping doom. The charts will keep whipsawing. But you know the truth now. You understand how the game is played. You see the liquidity traps. You recognize the manipulation. And knowledge is power. If you have questions, don't hesitate to comment below. I'll make a video answering your questions because this community deserves transparency. Thank you for the support. Now hold the line, watch that $75 level, and prepare for the next leg up to triple digits. The war is far from over, but we're winning. Stay strong.